Good morning, everyone. This is Fabrizio Duva with PENTalk Retirement Services, and I trust all is well today and you had a great weekend, and want to thank you for participating in today's WebEx on executive retention strategies through effective retirement planning. Today's presentation will focus on the framework in which community banks can look to retain their top executive employees and also look to, from a succession planning standpoint, of moving and retaining those individuals that banks wish to succeed management in the future. Today's presentation will look at what some of those objective and competitive approaches are to designing these type of retention programs, ultimately looking at what other banks consider in terms of whether other community banks are providing for their employees, and then give you some design features in terms of the type of programs that are available in addition to existing retirement benefit programs that your banks currently provide. So with that being said, this presentation will probably be about 30 minutes long, and I'll certainly be able to answer your questions along the way. And there are really two ways of asking questions. One of them is you can raise your hand via the GoToWebinar, and I'll be able to unmute you individually to take your question, or you can type it in as well, and I can answer it along the way. And then I'll also field some questions at the end of the presentation. So with that being said, we can get started on today's WebEx. Retirement plans are obviously an important part to any bank's success. In today's environment, there's obviously many challenging risks facing community banks, consolidation being one of them. And so attracting and retaining talented employees is a big challenge. The total rewards package that you provide for your employees is a key competitive resource towards retention. Benefits are an important component of that package. You know, employees really do cite that health benefits are really the single most important benefit that an employer can provide to them. However, not to be secondary, but retirement benefit programs are as, if not as important of a benefit that you as your employer can provide to that executive. And our chart below just simply suggests that you know, as we approach older in age, that retirement benefits offered by an employee are a major factor in decision to accept that particular position, and that particularly makes sense. As we go along this presentation, we will talk a little bit about when is the right timing to implement these type of programs, and the strategy behind that can impact some of the expenses associated with it. So it's obviously earlier the better to start to implement these type of programs, but we'll talk a little bit about that further in the presentation. Some key features of executive benefit programs really are as follows. These are the approaches that we take with our community banks to help them understand why are we considering these type of programs. One would be to replace income at retirement based off of total non-limited compensation. And what I mean by that is, as an example, you know, the IRS has certain salary limitations. This year, for example, it's $270,000. So for banks, as an example, that might have a pension plan, that formula, if it's a computation based off of salary, well, it's limited for that individual at $270,000. So if that individual makes more than $270,000, well, they're not fully benefiting from the full pension benefit. You can replace benefits lost due to IRS limits and qualified plans or due to historical formula changes. So in this particular example, we have community banks that used to have pension plans and then went through a hard freeze or even a soft freeze. And as a result, maybe they even changed the formula on the plan. These type of programs that we'll talk about today can essentially mirror those benefits or make them up for any changes that it may have been done in the past. And quite frankly, some banks in the third bullet don't offer certain retirement programs. Certainly we see today that banks that have been around for a long time, let's say 30, 40, 50 plus years, traditionally they'll have a pension plan, which hopefully is still active. But if not, then maybe that 401k plan was brought in addition to a match. But when you think about the retirement benefit programs that are available to maybe newer institutions, a pension plan typically is not part of that retirement program. And simply they're left with a 401k with a match, maybe an ESOP or a profit sharing plan. And so the retirement benefit programs today for newer community banks may not be as robust as some of our older institutions. So these type of programs we'll talk about today will help supplement some of those programs that are not made available. A very simple type of executive benefit plan with minimal cost is a pure deferred compensation plan. We have many officers who are perhaps looking to defer salary over and above what they defer on a 401k plan, and or even defer some bonuses as well. And deferred compensation plans are a type of program that will allow that executive and, quite frankly, a director to also defer fees as well for them. And then last but not least, a key feature to executive benefit plans is that they are providing enhanced benefits in the event of a change of control, disability, and death. These are life events that, quite frankly, when it comes to a 401k plan, as an example, you basically are entitled to whatever you have in your accounts. But under executive benefit plans, there are ways to enhance the benefits if these certain life events ever take into place. And we could do that by not only protecting the institution's interests, but also the families of the top executives of the banks. So when we first look at these type of programs, and we're having an initial conversation with our prospective banks here, what we're trying to help them understand is how do we translate the business objective to the benefit philosophy. And so we really do come in and just get a general sense of what are the strategies that the bank has taken in terms of compensation. And as an example, some institutions like to pay higher compensation as opposed to providing supplemental type benefits. And then there's the opposite view as well. Well, we pay a lower amount of compensation. We like to retain services of these individuals by providing some long-term benefits. Then we're also looking at the type of plans that are available, and we'll discuss what those plans are today. We do an analysis of what your peers offer as well. Many institutions will look to a compensation consultant to help them understand the overall compensation and benefit strategy for all of their employees. And we have relationship with our comp consultants as well. And when we look at some of the objective approaches, and I start talking a little bit about percentages and targets of what certain executives should receive, that is information that we are getting directly from our comp consultants. And ultimately, those comp consultants are working with your peers, and your peers are offering certain benefits as well. And I'll show you a slide here that kind of looks at exactly what we provide to our prospective banks in terms of, what are other banks providing to their employees. The demographics of your employees is an important part of the conversation. Certainly when we're looking at older executives, which is typically the older demographic of executive management, time is really an issue there, meaning how many years of service do we have left for that individual, because that'll be a key component in terms of the benefit amount that we could look at, which translates into the amount of expenses. And then also for younger employees, we would like to retain their services for the long term as part of any succession planning. And then the maturity of your institution. I briefly just talked about how old your institution is. What do you currently have in place in terms of a benefit program? What do you currently not have in place? Are you still a de novo bank, for example? These are all key important demographics of your institution in terms of how we're going to end up looking at certain type of benefits. There's really two approaches when we look at how a bank should consider developing a benefits philosophy. And these are two separate approaches, and although they're not, they are exclusive, but when you commingle them together, that's when we have a successful benefit program, which will be a blend of both philosophies. So what is the objective approach? The objective approach is that compensation and benefits are offered to fulfill a specific function. And that function is when your executives retire from your institution, they need to have a certain percentage of income accounted for that they need to live for the remainder of their lives. And that percentage is not going to be 100% of their pre-retirement income for post-retirement benefits. Experts recommend that, for employees retiring over the next 5 to 10 years, that you should have about 70 to 90% of your pre-retirement income to maintain a certain standard of living in retirement. Now, out of that 70 to 90%, there's going to be two buckets of money. For community bankers, that two buckets of money is how much did my employer provide towards my retirement, and then how much did I provide of my own? So the example for that is the 401k. You as the employer are deferring your own salary, and your bank is putting a match, and they're deferring on your behalf. So at retirement, you look at your 401k balance, you'll also look at some other retirement programs, and you'll have the flavor of, well, how much was provided by my employer, how much was provided by me. Out of that 70, 90%, for a president and CEO, about 60% should be coming from the employer. And we start with the president and CEO as a baseline and work our way down. And I'll quantify what that is for other executives in another slide forthcoming. So that's your objective approach. We're trying to target a percentage to retirement of pre-retirement income for post-retirement living. The second approach is competitive. And the reality is, in community banking, it's one of the industries where banks offer and pay for retirement benefits for their employees. Other industries offer that as well, but for top executives, they're usually putting away for their own retirement. In community banking, when you look at proxy statements and annual reports, banks that have SERPs and deferred comp plans and incentive programs, these programs are being paid by their employer. So there is a competitive approach that when you as a bank are looking to retain services and the bank across the street is already providing these benefits, well, you would want to potentially match or provide something in order to retain those services. And banks that offer these benefit programs generally experience lower turnover among middle and upper management, because ultimately the costs associated with turnover, or really the failure to attract and hire new executives, can run a substantial risk to running your business for a sustainable long period of time. All right? So what we have here is what we call a shortfall analysis. And this is the analysis that we prepare at the onset for each of our community banks, because we need to determine what is Bank A providing for their employees. So when we look at the four highlighted groups here, we start off with the president CEO, and what we do is take their compensation and we project it to inflate it at 3% to a projected retirement age of 65 in this case. Then from there, we need to understand what is going to be their projected total compensation at retirement, and what are the various benefits that the bank is accruing for or providing for in other retirement benefit programs. For this particular institution, they're going to provide 50% of Social Security because you as the employee provide the other 50% towards your retirement. So we're looking at employer-only type benefits for this analysis. So in this case, 50% of the Social Security benefit is going to provide about 7.23% of the final total comp. Then the 401k match benefit for this particular individual, we're assuming that they're going to receive 5% from a safe harbor match on an annual basis, and that 401k is going to increase from an interest rate standpoint of about 6% per year. So when we annuitize that to provide a 15-year benefit, that's going to provide $28,500 approximately, or 8.75%. Then this bank also had a pension benefit that's going to provide about $16,000 or 5%. So what we glean from this analysis for the president CEO is that their bank is going to provide about $68,000 of retirement benefits, or 21% of their final total comp. And when we look at the next shaded section, we've itemized the next three employees in terms of responsibilities: the COO, the CFO, and the CIO. And here you can see that if they had a pension benefit or not, they range in the 17 to 36% range. Obviously, those having a pension benefit are going to have a higher percentage of salary. Then we look at the next tranche of the lenders. They're ranging in the 18 to 23%. And then what we see at the final tranche here are some of the rank and file. Now, these aren't the executives that are going to be provided any type of executive supplemental benefits, but what's key about those executives is that you can see their percentages all range in about the 60 to 70% range. And that's really important because the leaders that are leading the success of your bank are actually going to retire with a lower percentage of their salary as opposed to the rank and file. And so that's another reason why banks choose to implement these benefits, is that they want to bring their top executives in line from a benefit standpoint with some of the rank and file. But clearly we understand that those rank and file officers or employees are retiring with a higher percentage simply because of their lower compensation. But still, the reality is they're retiring with a higher percentage. So I have a question from Charlie Abood here of who prepares the shortfall analysis. And I will tell you that this is something that Pentegra does for your community bank. Meaning, if you have a meeting with us, subsequent to this meeting, we have a conversation about why you're looking to implement these benefits, but we will request certain census and compensation information, and then run these numbers for you to help you understand from president, CEO, all the way down to some of your rank and file, what they're projected to retire with at retirement. Because this is going to set the foundation for what we're about to talk about next, which is, well, how do we get these executives to a certain percentage of final compensation, and what type of benefit programs can you offer to do that, and subsequently, what are the costs associated with it? Before we get to that, here's the peer group analysis that we also prepare on your behalf. So what we do is we take about 10 banks and we look at geography, based off geography and asset size. Some banks also like to give us an asset size they want us to work with. And what we do is say, all right, when we look at the proxy statements and annual reports for all these institutions, What do they have from a 401k match standpoint? What do they have in terms of other retirement benefits, such as the pension plan, ESOPs, stock options, employee contracts? And then when it comes to supplemental executive benefits, what do they have on the non-qualified side? You know, do they have a defined benefit SERP or a defined contribution SERP? Do they offer deferred comp or life insurance? And typically that life insurance is done through BOLI. And then subsequently the BOLI is used to generate earnings to offset the expenses associated with the non-qualified benefit plan. So this peer group is going to give you a summary of what your peers are offering. At the end of the day, you may not make a decision simply because your peers are doing it, but certainly you benchmark a lot of what you do from an institutional standpoint compared to what your peers offer. And executive benefit plans should be no different. So now that we have set the baseline of what we're going to be looking at to accomplish here, now we want to know what are some of the type programs that we can look at to implement these programs. So first and foremost, we have executive and director deferred compensation plans. These are plain vanilla deferred comp plans. So what I mean by that is each individual, whether it's an executive or director, can choose to defer their salary or their fees, and the institution will hold on to that. So rather than paying that out in compensation as part of salary or fees, it would be held on the bank's books as a liability, and as a result of the bank holding that money instead of paying it out, that institution will then credit interest to that account balance. And in today's interest rate environment, we're typically designing a deferred comp plan to earn about prime rate as a floor, and then typically we put a ceiling on that as well. And that ceiling can be anywhere from 8 to 10%. And the ceiling is important because if we go through an extreme rise in interest rates, at the end of the day, the really only expense to a bank on a deferred comp plan is the interest cost that you're crediting to the account balance. So we want to mitigate any potential interest rate risk in the future, should those rates really drive up significantly. That can always be changed in the document, but it's certainly a protection from the bank standpoint. Then ultimately, these deferred comp plans, they're accumulating on an annual basis, not only any contributions, but the increase in the interest rate that it's earning, whereby at retirement, the executive or director can take the benefits out in an annual payment payable by the bank, anywhere from 5, 10, or 15 years, or it can also be paid in a lump sum. So that's a pretty plain plan, and I will tell you that directors really like the idea of a deferred comp plan because typically directors may own their own businesses. They're entrepreneurial in spirit, meaning they may not require the fees from board meetings to live off of. For them, it's supplemental income. And a deferred comp program for a director will allow them to defer any tax until they take the distributions out. It would actually allow them to defer their fees and overcome any SEP IRA limitations that they would have for that particular plan. So it's really a way for them to maximize some tax-deferred growth and earn some additional benefits for retirement. The following couple plans are the SERP and the Executive Incentive Retirement Plan, and I'm going to gloss over that on this one because we're going to go into a little bit of detail on the subsequent pages here. So I'll get into those a little bit more. But the Benefit Equalization Plan is actually a type of SERP. A benefit equalization plan can actually restore retirement benefits lost due to any various limits placed on IRS qualified plans. So I mentioned that a little bit earlier. And it can correct any plan salary limits or any defined benefit maximum limits For example, a pension plan's maximum benefit limit is $210,000. So if the executive was in a pension plan and we looked at total non-limited benefits, and let's say that executive was entitled to $250,000 from a pension plan, well, we could take that $40,000 difference and put together a type of SERP that will pay that benefit on a non-qualified benefit standpoint at retirement. But like I mentioned, today we're going to focus on the traditional SERP and the executive retirement plan, incentive retirement plan. So we have a case study that we did for this particular bank. And we're going to look at the SERP here as a way to provide executive benefit plans really for two distinctive tiers of employees. One is a defined benefit SERP. And this is a traditional SERP in that it is a plan designed to reward executives, your top executives, usually your top 2 to 3 to 5, depending on how large your institution is. For some of your larger institutions, that whereby you have specified employees, we're really looking at your top 5. Smaller institutions, maybe your top 1 or 2 or 3. And it's a reward for past performance, but also an incentive to stay for the future. And the defined benefit SERP, the reason why we define it as a defined benefit is that we, in an agreement between the employer and the executive, we are going to define the percentage of final or average compensation, or we're going to define a fixed dollar amount within that SERP agreement. So what ends up happening is that it's a more predictable type of retirement benefit program, because if I know from an accounting standpoint that I need to accrue towards a fixed dollar amount or a percentage of salary, the accruals become a lot more predictable. All right? Now, this type of agreement can also provide the benefit be offset by any bank qualified plans, meaning when we looked at that shortfall analysis earlier, we saw that the president CEO was about 21%. Well, we're going to see a pro forma shortfall analysis where we get that CEO to about 60%. So in the agreement, we could target the SERP benefit to state that that individual receives 60% of their final compensation offset by 50% of Social Security, 401k match retirement benefit, pension retirement benefit. So that could be written into the document as well. These benefits can be payable on a lump sum or for a specific period of time, meaning you could pay this benefit over 5 years, 10, or 15 years. We actually design a lot of programs under the SERP where it provide lifetime benefits guaranteed for 15 years. So you're accruing to a point for a benefit that will be payable for lifetime for guaranteed 15 years. Now, lifetime today, based off mortality tables that are used, provide benefits for about 18 years or to age 83 when you look at an age 65-year-old. So a bank would be accruing to provide 18 years of benefits, but if that individual were to pass away in the 13th year, as an example, well, the bank could still pay 2 more years to the beneficiary for a guaranteed 15 years. Now, Pentegra works with your attorneys in terms of drafting these agreements, because within those agreements, we need to specify certain vesting, death benefits, change of control, disability, and early retirement. And these are really important key features in the agreements. When you look at vesting, the reason why you're putting these type of programs in place is because you're looking to retain the services of your top executives. Well, the vesting component of that language is ultimately responsible for that retaining tool. And typically banks are vesting depending on the years of service remaining. So if you had an executive that has 8 years of service remaining, well, you would vest in that benefit over an 8-year period. If you had an executive that's about 15 to 20 years out, you may not want to vest over a 20-year period. What some banks like to do is within 10 years of retirement, that executive may not necessarily be entitled to any benefit for the first 5 or 10 years, but once they hit age 55, then that bank may start to vest that executive into the benefit over the remaining 10 years. Some other strategies in terms of vesting are a combination of years and age of service. I'm sorry, years of service and age, meaning if an executive combination of age and years of service equaled 75 or 80, well then that's when that individual will be entitled to the benefit. So you have a lot of flexibility in terms of vesting. It's just a matter of the demographics of that individual and ultimately the impact from an accounting standpoint that vesting will have that leads into that decision. Death benefits, these type of programs can offer a death benefit whereby if the individual passed away at age 57 as an example, the bank could actually pay the normal retirement benefit as if date of death equaled normal retirement. So what the bank is doing in that case is providing a death benefit to the families that would provide a full benefit and not to shortchange the executive's family because the individual passed before normal retirement. Change of control, we make sure we work with our banks to help them understand that if there's any benefits upon a change of control that are accelerated, that those benefits are in harmony with any other benefits that are accelerated under any separate agreements or any other employment agreements, because I don't want to go off into a different tangent here, but 280G is a concern for banks that are going through a change of control because 280G is a calculation that needs to be done for any accelerated benefits. And if any accelerated benefits exceed a 280G limit, not only is the bank on the hook for some adverse tax consequences, but so are the executives. So a bank should always be aware from all benefits that they provide their executives, whether you have them now or in the future, what is the consequence of a change of control on those benefits. And your attorney will help calculate that 280G calculation for you. Then disability is often something that we like to talk to our banks about. For institutions that have these type of benefit programs in place, we typically design a disability benefit to defer any CERT payments as a result of disability until retirement age 65. And here's a hint. For any banks that have CERPs in place right now, look at your disability language. Because if it pays a disability benefit within 6 months or a year of that executive becoming disabled and then taking a CERP benefit, that CERP benefit is taken in as income, and that will adversely impact any long-term disability payments that your executive is receiving. So by deferring a CERP payment to age 65, that's typically when long-term disability disappears. That's when your executive should start to take a CERP benefit as a result of disability. So if you have any more questions about that, certainly let me know, but that's a little tip there for your existing benefit programs you might have for your executives. Early retirement really is just a function of vesting, but we put language in there to help our banks understand what should happen in the event of early retirement. Now, as a result of whatever type of CERT plan we put in place, now we need to understand what are the subsequent benefit amounts and what are the expenses associated with it. So for this particular bank, the president and CEO, again, retired was projected to retire at about 21% of their final total comp. So they wanted to look at a CERT benefit under the defined benefit plan design that would get that president CEO to about 60% of their final comp. So we needed to look at about $127,000 CERP benefit over and above all their qualified plans that when you total them up, it would provide 60%. And then employee 2 and employee 3, they wanted to get to about 30% of final total comp. So we now understand what the benefit amounts are. So these are annual benefit payments that would be paid to the individual for lifetime guaranteed 15 years, or they could take that in a lump sum. So that $127,000, when you accrue for it and you apply a discount rate, I think we used 5% for this case, at retirement, there is a liability on the bank's books whereby they could pay that individual out $1.65 million and they could take that in a lump sum as opposed to the 15-year lifetime benefits. Now, with any benefit program, not only is a bank considering why we're looking to implement this benefit and ultimately what the benefit amount is, but just as important is what is this going to cost to us? Because ultimately, that is the biggest decision. What is the expense? Can we afford it? Can we absorb it? Is it worthwhile to retain our executives? And what is going to be the impact to our bottom line? So we just kind of show our banks, this is a summary of a cumulative and annual benefit expense for, the next 20 years. But we actually provide our banks with full, detailed accrual schedules. That way on a year-to-year basis what that projection will look like. And ultimately, these expenses are net to a bank. So there's a gross expense and then a deferred tax asset whereby you have a net expense to the bank's bottom line here. What I will tell you for this, if you're looking at Plan 1, 5, and 10, you could see how the expenses ramp up over the first 10 years. Well, starting in year 11 or 12, some of the executives start to retire, so then your expenses start to reduce because these executives are starting to retake their retirement benefits. So the liability is reducing. So this is your defined benefit CERP. Now we're going to move on to, well, what is a way to provide a retirement benefit for our second tier of management, those that we want to retain for the long haul as part of our succession planning. And this is a defined contribution CERP. So a defined contribution CERP works differently than the defined benefit CERP because the defined benefit CERP, like I mentioned, we are defining the benefit amount, and then the accruals are much more predictable. Whereas under a defined contribution CERP, what's happening is on an annual basis, the bank is setting up certain benchmarks that their executives need to hit. And those benchmarks can range from budgeted net income, ROA, ROE, your quality of your loan portfolio, etc. And you set a matrix up that if an individual hits a certain number, then an award will be paid, but not in cash, like a short-term cash reward, but it will be deferred. And now it's deferred and there's vesting, so now it makes it a long-term retaining type benefit. And this works really well because ultimately your board and your bank, if you're paying a reward out, it means that your bank is performing well. And what's better than management and the director's philosophy on benefits, being married together, that everybody's going to benefit, not only the board from a shareholder standpoint, but also the executives because they'll be earning a reward because they hit certain benchmarks. So the annual awards that are deferred are also earning and crediting interest rate, like I talked about on the pure deferred comp plan. That interest rate can be prime rate. It could even be the total return of the bank. Some banks that aren't public institutions actually create a phantom stock plan through a defined contribution SERP, because they're, instead of paying out stock, they're paying out awards, and that award can be, can grow based off, the total return of the bank. It can actually be done for a stock company as well, whereas the growth of the stock can impact how that account balance will grow on an annual basis. Just like the SERP and the deferred comp, these type of plans will be paid out in a lump sum, or they can be paid out over a specific period of time. These benefits will accumulate based off the awards on an annual basis and then paid out retirement. And then the amounts deferred aren't taxable income to the participants or heirs until they're actually received. All right. There are expenses associated with this type of plan as well. But before we get to that, here we show a chart that this institution wanted to get to a certain proposed annual benefit to target a certain percentage of salary at retirement for these 3 employees, meaning that employee 1 would need to have 11 years in the plan and generate about 19% of their compensation, and that compensation would grow, or that award balance would grow at a certain credited interest rate, and then at retirement, when you annuitize the benefit, it would pay out about $21,000. So that would be a percentage of that total comp to get them to a certain target. And we did that for employee 2 and employee 3 as well. Now, the accounting considerations under an executive incentive retirement plan are different than a defined benefit SERP. Under a defined benefit SERP, the accounting behind the plan is really a present value calculation, where you have a discount rate, we're targeting a number, and the components of that accounting are basically your service cost and your interest cost. The accounting behind a defined contribution SERP are simply that whatever the award that's supposed to be paid out that's deferred, that's one expense, and then the interest cost. So, if you're looking at prime rate, we're looking at about 3 3/4 to 4%. That would be the interest costs associated with this type of plan. Moving along here, now we get to, well, we've looked at these SERPs, the defined benefit and defined contribution. Now, what do these type of benefits translate into our original shortfall analysis that we looked at? And so that president CEO that originally was at about 21%, when we add in the SERP benefit, we're adding in about 39%. So we're getting that individual to 60%. And as I mentioned, 60% is the target number in today's compensation and benefit environment. We didn't pick that number out from the air. We actually work with comp consultants that tell us 60% is the norm. It can go as high as 70. It could be as low as 50 for a president and CEO. Pre-2008, we were actually designing benefit programs that could have ranged anywhere from 80 to 100%. So certainly that mentality has changed across the board, not only in terms of what executives should receive from a comp standpoint, from also a benefit standpoint. So once we determine what the president and CEO should get, then we work our way down. So in this particular case, the CEO was really second in line, and they wanted to provide a target from all benefits to be 50%. So that SERP benefit, we needed to get 16% of final comp. The CFO, they wanted to get down to 30%. In fact, for the CIO, they wanted 30% as well, but because the CIO had a pension benefit, they didn't need to give a SERP, and as a result, they basically, that individual is going to retire with 36% of total comp. So there was no SERP given. And then for the lenders, the target there was 30%. So the IRP benefit from the defined contribution, that benefit ranged anywhere from 6 to 12%. All right. Now, Another item that's important to understand is that these benefits do not need to be offered to your entire employee base. These are discriminatory type plans. They do not fall under the ERISA guidelines such as your 401k, pension, or any other qualified benefit plan. So not only do we have a lot of flexibility in terms of who we can offer the plans to, we have a lot of flexibility in terms of how we design them, in terms of the benefit amount, and the language within the agreement for each individual. And that's really another key component to these benefit programs that you can do under the non-qualified. So last but not least, you have two decisions that need to be made from your bank standpoint. One, if we want to look at designing, implementing a non-qualified supplemental benefit plan, we have a benefit decision, and that benefit decision is going to create an additional expense. So your second decision is, are there opportunities to offset expenses associated with these plans? And a bank's normal course of business is to take in deposits, make loans. You can also purchase securities, and you operate in that fashion, and any income you use is used to offset expenses. Banks also like to use the strategy of using bank-owned life insurance to generate tax-free income to help offset these expenses as well. At the end of the day, you as the institution have these two decisions that will impact the financial statements to your bank, and a sound asset liability management strategy incorporating both decisions will not only provide meaningful benefits to your bank's top employees, but also potentially do it while creating a positive impact to the bottom line. Okay? So with that, I can field a question here from Beth Parker that do these plans apply to directors as well? Yes. As I mentioned, a deferred comp plan is definitely a plan that we would recommend any bank to implement for their directors. Again, because it's plain vanilla. Again, because the directors typically do not need that type of supplemental income for living purposes. When it comes to pure retirement benefit programs for directors, if you wanted to design a SERP for a director, as an example, for public and stock institutions, it is not a common practice to implement those type of programs because shareholders typically have an issue with providing any type of retirement benefit program for a director. For mutual banks, we don't see it as often today, but it's certainly a kosher benefit or something to at least explore for your directors. And typically a director retirement plan will be a percentage of final fees, usually 50%, and payable for a 10-year period, because if you think about it, normal director retirement ages off of board are anywhere from 70 to 75, so you provide that retirement benefit for about 10 years, or again, even in a lump sum. So for anybody that is interested in learning more about this, Pentegra will take the time to come meet with your institution, and ultimately we will sit down with you to go over all of your objectives. We will prepare that shortfall analysis with you and then discuss the type of benefit programs that will fit to achieve your goals. And then ultimately, we quarterback on your behalf, working with management, presenting to your comp or HR committees, ultimately getting it to the board for approval. And then Pentegra helps to design the agreements with your attorneys, work with your accountants from an expense standpoint, and then ultimately help the bank with the accounting schedules and servicing and administration of these type of programs. So it really is a turnkey approach for any type of banks that are looking to implement these non-qualified benefit programs for top executives and directors. And with that being said, just want to thank everybody for their time. You will receive an email with a copy of this presentation forthcoming in the next day or two. And if there's anybody that has questions at this time, feel free to ask. If not, you can always reach out to me at a further time. All right, thank you very much.